Maverick, Samir Arora joins us. He joins us live from Singapore. Singapore only, right? Yeah, I can see his office. You can recognize the bulls, that lovely painting. Office, Singapore, right?
Correct.
Correct.
Then you're not here or what?
This is the
How?
new office. You invited me to the old office.
No. It was always, I've been here since 2008. Yeah.
I came before that, no? That is why. Okay, markets have been surprisingly resilient. Can I say that?
And today was not a surprise because currently it had fallen. So it's, yeah, okay, in line, you can say.
The entire geopolitical tension historically, when these things have happened in the past, that have had a greater short-term impact on the market mood and the market sentiment. This time, if I just map the 3-day window, the markets have not been nervous. There has been no big sell-off, spike in volatility, and even foreign institutional investors have been putting the shoulder to the wheel by buying into stocks.
So, that is true. Actually, if you see even this quote that when you hear the first sound of bugle, which is like the announcement of a war, you're supposed to buy stocks and things like that. But I think that is not the main point. Main point here is that it has looked from after, Pakistan did in Pahalgam, these horrendous murders and all that. And then India responded. Every time India has, while escalating, responding, whatever is the word, has simultaneously said that we have finished it and we don't want to do more. And then, of course, the surprise has been that Pakistan has done it a second time and maybe a third time. But at least the way it is happening with via drones and this thing, they are being intercepted and there doesn't seem to be big loss of life or any big infrastructure being destroyed. It looks that it might end soon because nobody is using the super serious weapons in that sense, and obviously not mobilizing army or air force in that sense. So therefore the expectation is, which is what happens most of the times, that it finishes in a few days. And then the history is that the rebounds are quite sharp. And therefore, there's no need to panic now unless somebody really knows something very specifically. Then what can we say? But broadly, if you use probability, the 70-80%, even maybe 90% probability would be that these things sort of die down a little bit and maybe completely in a few days. So you are selling, trading for a 2-day window, which you think you will catch the rebound, and mostly you will not.
I say that the real thing to focus on is actually tariff war, not what's happening on the geopolitical front. I mean, that is something which markets should focus on rather than what's happening between India and Pakistan.
No, so the backdrop is the tariff war, which is that the tariff war is if helping India in two ways. One, it is helping India in a relative, both are actually relative, you can say. One, it is helping India in a relative sense because India is better aligned with US on what is expected and gives closes some of the gap with China. And even if the gap was the same, the world would like to now have a, just like they were after COVID, setting up a China plus one strategy, because at that time it looked at, if COVID is there in one city and you happen to be only there, then you are stuck while the world moves on, or in that, or the country. And now the second time is that geopolitics. What if Trump again gets angry with China? They will think, even if the duties were same, which I don't think they will be, China will still have, even after negotiations, say a 40-50% duty, I think. So that is one advantage to India relatively. And the second is that the world has, I think, nearly agreed now that the overweight position that they have in US market, equity market, is a bit too much. Now, you could have said this last year also, the year before also, but over the last 15, 18 years post global financial crisis, the weightage of or amount of money invested in US is totally disproportionate to anything. Nowadays, it's like nearly 70%. And the longer term history used to be about 55%, while the GDP share is okay, 25, but doesn't matter. US companies are bigger, they get full free float and all that. So 50-55%, chalo, theek tha. But to have 70% was like reaching the upper limit, and you needed a trigger, and you can see it. You can see it in the articles that come on how much foreign investors have invested extra in US over this period, which I heard one hedge fund manager saying $20 trillion. Big picture, you can also calculate by saying that they are about 10, 12, 15% overweight. Look at the world market cap, things like that. So if that money little bit flows out of you, it doesn't have to be a lot, 5%, let's say. So the 70 becomes 65 over 2, 3 years, not even 1 year. So then the 30% audience gets 5% more. उनका तो काम हो गया, they are set in life, and we are one of the smaller guys there in that 30%. And so the flows, if they turn, then you are in a sweet spot, not today, but after this is over in a few days. And they had already turned that way before this. Both mutual funds and FIs wanting to buy will be a new thing for us. Last 2, 3 years, it's been one guy selling, one guy buying.
When you speak to your LPs, do you get a sense that the flows which have come back into India, especially the foreign flows, which you've been talking about it for a while, they're durust hai, but once they are back, are they here to stay? Are we going to be
Yes,
the here to stay?
100% they are. Because we got one new account in October. Well, that account has just by money and not by NAV as much has gone up around 50%. Matlab every month they add. So, and they are saying now we are going to give you from this account, that account, let's see. But broadly, and even in our long short fund, which is not so much having this endowment type and all that money, they're also, they haven't put much, but nothing has been redeemed in the last 2, 3 months, not even $1. So, but in the long only, so they have put for us big money. Yeah. So basically, it's and also there are a lot of interest and a lot of discussions, I think, driven by the fact that India had broadly done well and then it had this correction. But post this, US, I think nearly everybody agrees in the institutional world that they are overexposed to US. You can see that, I think Goldman puts out like a monthly or not quarterly, monthly, or weekly, where are the flows going, and even there you can see that the selling in US is very high. In fact, just today, there's an article in Bloomberg saying that Asian families are reducing their exposure to US. They are not saying where it is going, but pale US exposure is coming down means it is being reallocated to rest of the world. It's happening. And India, you can see it also in the last 20, 25 days, including yesterday, totally more than $5 billion have come in, which is pretty good these days to have that amount in a short period of time.
Samir, but given the fact that the FIs have been on the buying streak, hopefully all these tensions go away, and that is a developing situation that we have been watching. The tariff goes in favor, something on the positive lines we get to hear in some time from now. If all these things pan out and work well for the Indian markets, then it's a clear indication that one should take the opportunity of today's volatility in a couple of weeks ahead and go ahead and buy. So help us understand.
Yes. So first thing,
please.
I still don't expect massive returns because valuations come new, the results are not great, but you will have good good performance. I'm not thinking just because of this technical issue of both wanting to buy, you can make 30% in a year, which you make in good years sometimes. But at least let's go up, go 10, 15% up. In terms of buying today or Monday, that depends on, we say what you do depends on what you have done. So if let us say somebody has some fund has 3% cash, he doesn't have to buy it because psychologically it's like, okay, I have 3%, I will wait. It won't change his life either way. But if you have a lot more cash, or in our case, because we have a long short fund where we keep changing the net, we will definitely look to cover some of it maybe today. Yeah. But the thing is, so therefore, it's not necessary that you have to do it today. The first thing you have to do today is not to panic, because this panic would be unreasonable, because what is the scenario you're drawing to panic now that you think it will be much, much worse? If you think it will be much, much worse, then you please tell us also why you think of that. But from any angle of rationality and logic and prior this thing, and the way world comes in and tries to sort of calm things down, and the fact that India in every escalation simultaneously says we are not doing it if you stop it, for whatever reasonableness, you will think it'll be over. So therefore, all I'm saying, today, though, don't panic. Forget about buying. You want to wait for a day. It's not going to make such a big deal. But recreating a position that you have sold, for example, I'm just saying big picture. Oh, suddenly travel. Of course, this month travel will be down, tourism will be down, maybe hotel booking will be down. But for that, you don't write off stocks which are supposed to be there for 20 years, 10 years, actually forever, disproportionate for 15 days of cancellations or whatever, things like that you're not supposed to do. The most welcome to do will be on the other side, and others will be on the other side of such foolish responses if that is what somebody wants to do.
Do you see a sentimental rub off helping defense, aviation, defense stocks, especially domestic and global? I mean,
Yes.
yeah, I mean,
Natural. Whether you may buy it or not, but that is natural. But again, I saw drone stock is up 17% now. I don't know whether his drones are being sold or what, but yeah, these things happen all the time. These things don't bother me much because if you look at it in aggregate, even the guy who's buying it, he will buy 3% of his this thing for his ego satisfaction. But that way they go and bet on teams also. Yesterday, one guy won, I think, $64,000 I read on the net because he betted that this US fellow will become the Pope. So everybody bets on low probability, high probability. So this is time pass also, no? Don't have to bother about it personally. It's to each guy's own.
Always candid, and we obviously love that fact. But give us some sense, and for the benefit of our viewers, help us understand that which sectors are you making some adjustments in your portfolio? Maybe in the long short, what is looking good, what is not looking that great right now?
So my big picture logic is that if the foreigner is coming in, which is part of the backdrop, because it's not enough to say that we are beneficiaries of tariff, because that beneficiary of tariff in that sense is not mostly our listed companies, but our economy. Okay, because if Apple says I'm going to come to India and sell mobile, export from here, maybe all the thing gets done in unlisted companies. So India benefits, the economy benefits, jobs are created, but directly and literally, I don't have a stock to buy, correct? For me, the direct thing at the beginning is that because of that and other reasons, and because Trump created uncertainty, and therefore people want to go out of US, therefore want to come into my market. And if they want to come into my market, the natural first port of call is the financial sector. Because A, that is the thing which the FI has sold for 2-3 years. B, they like it, we know it because they still have large position. And C, that is the group which is like a macro call, which doesn't have, which has reasonable earnings growth and does not have any, slowdown related with it right now. You compare it to IT, where if they are leaving US, effectively, they don't want to come and buy a second level IT company when they are effectively leaving the first level IT companies in the US, which had at that scale much better growth rate than we had in the most recent quarter. So if in theory you are leaving US to come here, you don't want that back. Plus if the currency strengthens and all that. So mere hisab se the first level is financial, but obviously nobody buys only one group, one sector. But financial should be best.
so Samir, apart from financials, which is the go-to trade, but the most crowded trade, what
No, not the
else?
most crowded trade. Sorry, wrong number. Please look at last 2-3 years performance of these stocks and tell me what is Kotak's performance, Bajaj Finance performance, HDFC Bank performance. Nothing. So how can it be crowded? And it is not crowded. It is going to become crowded when both want to buy. So far, one group was buying, one group was selling. And that is why even the value guys say, even Prashant Jain, very serious type guys who are always serious in their life, will say HDFC Bank is their top holding. And even the casual or whatever you want to call me, the fun loving guy will say it's HDFC Bank. But it was even for the guys who are very serious people. So therefore, it is not. Please don't call it consensus trade. It's not.
Prashant Jain is serious.
Yeah, he looks serious. He is
ये
serious.
बीच वाला कौन है
Thank him
फिर?
for his seriousness.
बीच वाला कौन है फिर? एस नरेन?
Opposite of me, but with the same stocks.
तो बीच वाला कौन है फिर? Who is serious and yet fun loving? Who is one fund manager?
That is me. Fun loving तो होना चाहिए साथ में. I mean, लगना तो चाहिए.
Yeah. And our viewers will recall that Samir is also, more like a magician. He knows how to do magic.
So I'm saying financials is one. Okay, let's go. So financials is one for sure. Baki, you will go here and there. I mean, no, what I mean is the others may not be so thematic easily definable. Somebody may buy a little bit of IT only, somebody may buy consumer, वो उनके preferences है उसके ऊपर. So it's not an obvious thing, चलो next. But if you say stocks, obviously, we hope that they buy the stocks that we have because they are not connected with tariff and they are not connected with war and tension. And in fact, you might be sitting at home watching TV and maybe not going out and may eat even more sitting at home. You know which stocks.
You also give us some sense on the IT space. I know that you have touched that bit. I just wanted to get a deeper sense that how do you analyze the earnings? Because this time for now, though the numbers were not that great, especially from the large cap companies, but the valuation was something that the investors were liking. Along with that, there's also a hit to the US economy, and we are talking about the recession. I'm not sure whether this will happen or not. Nobody is. But what's your reading on the IT space, and where do you see the sector headed?
You see, at 2% growth, what do you call valuation? I don't know. Second is you are being affected by AI. Everybody in the world, by the way, every US company says, I can't guide. Every Indian company still wants to guide. Thirdly, there is this thing about currency that, for 10, 15 years, the currency weakened so much and not even 1% of that was retained and the margin was still the same. And so our currency is strengthening. There are so many things you can say. For example, everybody says that there will be, say, 20% productivity increase with AI. Okay. And therefore we say, oh, we'll also use AI, not to worry. So we'll also use AI. So it is not, but the customer will not let you obviously keep the 20% gain. So let us say, I don't know, but let's say the way they talk is 18% customer will take, you will take 2%. So what a great improvement in margin. But the absolute amount of business, therefore, has shrunk by 20%. Now, of course, they say we'll find new business. But broadly, the thing is that you are running on a treadmill because every time something new is happening, affecting it. Oh, once in a while, you can also own one stock here or there. But thematically, I think after 25 years of this run, I think it is going to become like the levers and all of the world, which is growing very low rate because of the size. And you can see that also in the employment creation that they are doing. So, I mean, that is the best indicator of what growth they expect for themselves. It's not that anything goes to zero or does very badly, but then they become highly ordinary, boring kind of companies, which sometimes make sense in a bad environment. Oh, I want something very, very defensive, but growing at 2%. But, do you think we look like that to you? But there are people who buy these don't people buy consumer companies because the growth rate has gone from 2% to 3%? People buy. We don't.
All right, Samir, appreciate your time. So glad you could join us. Thank you for joining us. And, thank you for really giving us a very different kind of a perspective.
Thank you. Thank you.
If you like this video, then like, share and subscribe to ET Now.